Gold versus Bitcoin. Man, it's a debate that just never seems to end, right? But what if we've all been looking at it completely wrong? What if there's a hidden signal in how they move, a signal that tells a much bigger story, one you probably haven't heard before? So let's just get right to it. Here's the big question we're tackling today. Is gold's price secretly predicting what Bitcoin is going to do next? Now, it's a really tempting idea, right? But the real answer, well, it's a lot more complicated, and honestly way more interesting than just a simple yes or no.
All right, so first up, let's talk about the most popular theory out there. I kind of think of it as the gold to crypto pipeline. It's this really clean, really simple idea, and you see it everywhere. You've got big-name analysts like Tom Lee from Fundstrat really pushing this idea. And his thinking is pretty straightforward. Look, when a big gold rally starts to lose steam, all that money, it has to go somewhere, right? So what's the next logical place? Bam, a surge into things like Bitcoin and Ethereum. And you can see why this makes sense to people. I mean, you've got these two assets that are both seen as alternatives to regular old government money, fiat currency. So the theory is, when the momentum in gold, the classic ancient store of value, starts to fade, investors just take their chips and move them over to the new kid on the block, the digital version. It's a classic capital rotation play. And hey, if you look at the data, at first glance, it seems to hold up. I mean, look at 2017. Gold had some decent gains, but Bitcoin's price just went to the moon. But, and this is a big but, if you look at other times like 2022, the whole pattern just completely falls apart. And this is where that simple theory starts to crumble, and where the real story begins. Okay, so that brings us to our next section. Because that simple rotation idea, it really starts to break down while we look at the one thing that truly drives investor behavior. And that one thing is risk. See, this idea of money just kind of sloshing from gold to Bitcoin is it's too simple. The real question isn't that it moves, it's why it moves. And the answer, almost every single time, comes down to how much risk the market is willing to take on. And this really gets to the core of what these two assets are. Think about it. Gold is the ultimate risk-off asset. For literally thousands of years, when people get scared, they buy gold. End of story. Bitcoin? It's the complete opposite. It's the definition of a risk-on asset. It's a high-stakes bet on a new technology, and honestly, it often trades a lot more like a hot tech stock than some kind of safe haven. So here's the key takeaway from that. Because they're on total opposite ends of the risk spectrum, you'd actually expect them to have an inverse relationship most of the time, right? When one goes up, the other should be going down. Exactly. Coin Bureau put it really well. A rising gold price isn't the starting gun for a Bitcoin rally. It's a warning flare. It's screaming risk off. And in that kind of environment, super speculative assets like Bitcoin tend to get hammered. So yeah, this completely contradicts that simple rotation theory we started with. Okay, so if they're opposites, that's the end of the story, right? Case closed. Well, not even close. This is where things get really interesting. Let's get to the surprising twist. What happens when this whole inverse relationship just completely flips on its head? This, right here, is the question that unlocks the whole puzzle. If gold is the safe bet and Bitcoin is the risky one, what in the world is going on when their prices suddenly start moving together, rising and falling in perfect sync? And look, this isn't some one-off freaky event. This timeline shows you key moments, major market tops and bottoms, where both of them moved together. That just shouldn't happen if they're simple opposites. It tells us there's a much bigger, more powerful force at play here. And here's the answer. The whole relationship flips when gold itself temporarily changes its personality. Yeah, you heard that right. When a gold rally gets hot enough, it stops being a boring safe haven asset. Suddenly, it starts attracting all the risk-on speculators who are just chasing momentum, just like they do in crypto. And in that moment, for a little while, they're both playing the exact same game. So, what kind of force is powerful enough to change the very nature of gold? There's only one thing. Global liquidity. You need to think of this as the master variable, the big boss of the entire market. It's the total amount of cash and credit sloshing around the global system. And when that tide of liquidity comes in, it lifts all boats. Stocks, crypto, and yes, even commodities like gold. Michael Howell, who's a total expert on this stuff, breaks it down into a simple cycle. Step 1, liquidity rises. Central banks are pumping money in. This is awesome for risk-on stuff like crypto and stocks. Step 2, liquidity peaks. The money flow is at max capacity. Speculative fever is everywhere. And this is when that money floods into commodities, turning even good old gold into a hot momentum trade. And then comes the dangerous part, the drain.
And that brings us to the most important phase, the great liquidity drain. And trust me, understanding this part of the cycle is absolutely critical for every single investor out there. So what happens when liquidity starts getting pulled out of the system? It could be central banks tightening up or big debt cycles turning over. Whatever the cause, it's just like the tide suddenly going out. And when that happens, there's just not enough water left to keep all the boats afloat.
You know, this quote from a Reddit thread just nails the feeling perfectly. When a huge liquidity event hits, it really doesn't matter what you're holding. Gold, crypto, tech stocks, you name it. Everything gets sold. It becomes a mad dash, a frantic rush to the only thing that's safe in that moment, cold, hard cash. And listen, this is not some abstract, theoretical thing we're talking about. Analysts are already pointing to 2026. Why? Because there's a massive debt refinancing wall coming. We're talking trillions of dollars in debt that all needs to be rolled over. And that can act like a giant vacuum, just sucking liquidity right out of the markets, potentially triggering the exact kind of drain we're talking about right now.
So look, if you take one thing away from this whole explainer, let it be this. A sharp drop in the price of gold is not your automatic signal to go buy Bitcoin. You have to stop and ask the most important question. Why is gold falling? Because if the answer is a market-wide liquidity drain, then Bitcoin isn't about to rally. It's the next one to get hit, falling right alongside everything else. Okay, so how do we navigate this? How do we use this information? In our final section, let's put together a new toolkit, a new way of looking at the market based on everything we've just learned. All right, here's your new toolkit. First off, just throw that simple rotation theory out the window. Instead, start thinking of the gold-Bitcoin relationship as a barometer, a weather gauge for the market's health. Number 2, pay close attention to when gold starts acting like a risky, speculative asset. That's a huge tell that we're getting close to a liquidity peak. The most important indicator of all, global liquidity. And a really good simple way to track that is to watch the US dollar index, the DXY. If you see the dollar start to surge, that's a massive red flag that liquidity is draining out of the system. And remember, when that happens, cash is king.
So that leaves us with a final, really big thought. What if we've been looking at this all wrong? Instead of a simple money goes from A to B relationship, what if the complex dance between gold and Bitcoin is actually the ultimate signal? A tell that doesn't just predict what they will do, but reveals where the entire global market is headed next. It's a pretty powerful idea, and one that's definitely worth keeping an eye on. Thanks for joining me.